Dear members, dear friends, dear treasurers, welcome to our first 2022 ATEL's conference. We hope you will enjoy these presentations and speeches. Today we will have three main parts. The subjects we will address are interesting, and according to the recent European EACT survey, there are key priorities for corporate treasurers. Nevertheless, the order of the presentation does not reflect exactly the order the priority have been classified by treasurers. But now, let's start. The first presentation will be done by Scope. Let me introduce Bernard Bartels, Executive Director, ESG Analysis at Scope. As you all know, ESG is an essential element to consider these days, and Treasury is also deeply involved on the ESG agenda. He will talk about green rating, which are important to determine investments. He will also address EU's Corporate Sustainability Reporting Directive, the famous CSRD, set to become a game changer for corporates, and eventually the limited usability of ESG rating amid new regulations raised concern among issuers and investors. Bernard, the floor is yours.
So thank you for having me on your conference. My name is Bernard Bartels. I'm the head of the analytical ESG team at Scope ESG Analysis GmbH, which is part of Scope Group, Europe's leading rating agency. And I'm very happy to present you today a few remarks on what we are currently observing in terms of ESG disclosure practices and how investors and regulators are currently viewing the development of ESG in the market. And by that, I would like to give you a few impressions what we think where ESG is heading over the next couple of months. So my agenda looks as follows. I will start with a brief regulatory perspective on ESG disclosure. Where do we stand and where are we heading? Then I will give you some remarks about the investor perspective on ESG practices. So how investors currently see ESG, how they implement it, and what is supposed to change in investor demand for issuers. And third, I will give you a short overview of ESG impact versus risk disclosure, which has to do with the rating agencies' behavior and how they respond to the current developments. But let me first start by giving you a brief impression of where Europe stands and what European corporates face when it comes to new ESG disclosure sets. I would like to distinguish between four concepts. One, the EU taxonomy. Second, the CSRD, the Corporate Sustainable Disclosure Regulation. The TCFD, and climate stress, which is something that is put forward by the ECB and the European Banking Authority. Now let's start in the sequence that we look at the most important short-term developments that you will be facing soon, and you are probably all already very much dealing with the EU taxonomy and with your specific requirements in the sector that the EU taxonomy is placing on you. So by 2023, many corporates across Europe will have to report on taxonomy related aspects. And here, this is a major development if we compare that to the existing regulation under the NFRD. So in principle, you are required to report three KPIs: sustainable shares of revenues, OPEX, and CAPEX. I will come back to those very important KPIs in a moment, but let's first of all keep in mind that we have the EU taxonomy coming very soon, 2023, for most of you. Now, the second large, big development in Europe is the CSRD. The CSRD is taking into consideration the EU taxonomy, but on top of that, corporates will be required to report on a number of other items that are part of the new Sustainable Reporting Directive, compared to the NFRD that we've seen before, you will also be supposed to report on supply chain exposures, supply chain management, principal adverse impacts, which are important for financial markets, and the sustainable finance disclosure regulation that financial markets are subject to. And you will also have to disclose more information about your business model. Now, those two important developments from the European side, the EU taxonomy plus the CSRD, are shaping the real economy over the next few years, with the CSRD being probably concluded this year, and then corporates need to report on CSRD regulation in the financial year 2023. So in 2024, we will see the first disclosures. While for the EU taxonomy, we will already see the disclosures from you in 2023. Now, there are two other important frameworks that I would not like to ignore, although the first two are, of course, bothering you most. One is with a full focus on climate-related disclosures to ensure financial stability. The Task Force for Climate-Related Financial Disclosures has been founded a few years ago in the UK, and it is dealing explicitly and only with climate-related disclosures, while EU taxonomy, CSRD, are in principle involving a lot of other aspects. The EU taxonomy for now in 2023 only climate change mitigation and climate change adaptation, but with some do no significant harm elements that go also beyond climate change, while the TCFD is only looking at climate change. And we are not yet sure at this stage to what extent corporates would also have to disclose certain metrics on their carbon risks, carbon exposures that go beyond what is currently discussed in the context of the CSRD. However, it might come your way, and I would like to make sure that this is clear. Fourth, climate stress. Here we have the European Banking Authority and the European Central Bank, both institutions taking a lot of emphasis also on climate, but not for the real sector, but more for the financial sector, so for banks, for insurance companies and others who will have to report the exposures of their lending portfolios and of their assets to climate stress. And this in turn also affects the real economy, because all those banks and institutions will require more data from the real sector to better understand the risks in their portfolios. So indirectly, the TCFD and climate stress will be topics that corporates are subject to and are exposed to in the near term once those regulations are put into place by financial market supervisors, and then affect also the disclosure practices of the corporates in addition to EU taxonomy and CSRD. So in principle, we see a lot of development, and I am very sure you are all aware of that. Now, one important element of this new regulation is the move from Scope 1 to Scope 3. What we currently observe in the NFRD and in practice is that corporates report a lot on their own emissions from greenhouse gas emissions, that they also report more and more on Scope 2 emissions, so on the electricity mix that they are using in their operations, but only few report on Scope 3. And even less corporates report on Scope 3 when it comes to purchased inputs or the use of the sold products. And this is really, really important, because those emissions are often much, much higher than what the corporates produce themselves. Except you are a materials producer, like in the cement industry, you are usually subject to a much higher Scope 3 emission production than what you are producing by yourself. The problem is that accounting for those Scope 3 emissions is exceptionally difficult if you compare it to Scope 1, because it's not under the corporate's direct control what is happening on Scope 3, but it's rather the consumers and the suppliers to the corporate which produce those emissions, and the corporate ultimately relies then on the suppliers' emissions disclosures, and it also relies on understanding better to what extent their products will be used in final consumption and will produce emissions in final consumption. So that's a very difficult topic, but it's becoming key. And to give you an example, the IFRS, which with its sub-body, the ISSB, International Sustainable Standards Board, they have taken this to the core of their activity. And I want to quote Emmanuel Faber, who a few days ago made this important statement, saying, we really think it's time for that conversation about the Scope 3 reporting methodology to happen. And someone really needs to be in charge, whether that's us or somebody else, I don't know. So in the end, we are not at the end of everything. If CSRD and EU taxonomy are concluded, it's going to go a long way further on from there. And why is that? Because we don't have common methodologies, we don't have consistency in disclosure practices, and that is something the ISSB is currently caring about, to have global standards that are comparable across jurisdictions. And this is a major effort that is needed here, and we are following this closely. Now, with this shift of focus from corporate to business model sustainability, we are currently at the beginning of this journey. As you can see, what we are really focusing on is trying to understand better what is the company-owned environmental and social impact and what is coming indirectly from the purchased inputs and from the impact, for instance, from investments for banks or from the use of sold products, both called downstream. So upstream and downstream are already components of the CSRD. There are components of the CSRD in the sense that this regulation is asking for a lot of details and supply chain management practices that corporates are supposed to report on. But this will go further. So in the future, we assume that corporates will have to apply certain methodologies to not only show whether they signed contracts with their suppliers, but they also have to provide quantitative figures on the exposure to those Scope 3 indirect emissions. And that is key for every sustainability measurement and assessment going forward. And I will briefly touch upon that when I speak about what rating agencies are currently doing. Now, with this in mind, with a regulatory perspective on ESG disclosure, let's move on and speak a bit about the investor perspective. Investors are currently focusing on ESG and on ESG impact in a very different way than what people often think. So the investments with the intention to achieve a measurable positive impact on society or with a direct link to sustainability make up only a very, very small part of the more than 30 trillion global assets with an ESG mandate. So whenever you see investments by financial market participants that have somehow an explicit link to ESG, that does not mean at all that those investments are making a positive contribution. And that's very important to note. And you see that on the right-hand figure, where you see that impact investment is still very, very small compared to all those other ESG types of investments, such as negative screening, ESG integration, engagement action, and so on. So in principle, what we see on the financial market is, in a way, the same flurry of different reporting standards, different ways of interpreting what ESG is in a similar fashion as with corporates, while I would say that corporates have already moved forward quite a bit, while financial markets are still very much behind and will have to catch up over the next few months and years. And this will be a very, very important movement that requires close attention. So the regulatory developments and the increasing sensitivity to greenwashing from the public push financial markets now towards more impact screening of portfolios. So financial markets will be more and more treated to make sure that their investments do have some sort of impact that is measurable. And this will also lead to more questions by financial market participants to the corporates on how they can actually prove that type of impact. In this regard, the CSRD will definitely be a game changer in Europe. What we see then from ESG ratings, and those are the ones that investment banks and other financial market participants currently use when they do their portfolios. Also, asset managers look a lot of ESG ratings. We see that these ESG ratings have just a limited value. Why is this? Well, the problem with ESG ratings is that compared to the normal credit ratings that you are used to, these ratings show a very high divergence. So if you look at the right-hand figure, you see that the correlation of credit ratings among the major firms is close to 1. In other words, there is really rarely a distinction between ratings when it comes to credit ratings on corporates. While if you look at ESG ratings, the correlation is a bit more than half the size of the correlation for credit ratings. And that's remarkable because if you understand that a corporate has a certain ESG rating and you see that in the market and you find another provider who is assigning a completely different ESG rating, then this opens the door for greenwashing. It creates a lot of uncertainty for financial markets, and it makes it explicitly difficult for the financial market to actually decide upon a certain portfolio. So those results that you see on this slide are basically shown by an academic study that is called Aggregate Confusion. And it compares the ESG ratings from 6 major rating providers across a sample of more than 900 corporates. And the sources of divergence that they find are reaching out from different measurement. So you have different types of measurement of how you actually assess the gender diversity or how you assess the corporate governance. Then you have a different scope. So some agencies incorporate the share of female on the board, others incorporate water consumption, and a third one is looking only at CO2. And then you have different weights. So even if you incorporate the same factors, you still apply different weights to those factors in the final assessment. And that mixture of different things leads to the divergence that we currently observe, and that makes it hard for corporates as well as for investors to ensure that they are contributing to the desired transformation without any clear guidance. This lack of the transparency in ESG assessment is further fueled by insufficient methodological publications. So for now, we don't even have the methodologies available that would allow us to assess why the ESG ratings diverge. And you see on the right-hand side all those different reasons why we observe that ratings diverge. Some include controversies, others don't. You have risk versus impact. So some ratings, they show what is the risk that the company faces from ESG-related factors. Others look at what is the impact of the company on wider society. Then you have relative versus absolute ratings. So some look at a sector only. Others let their ratings compare across the globe. You have different data sources that are used. You have huge distinctions between qualitative and quantitative factors. And then, of course, you have also upstream versus downstream, which makes a lot of the distinction. With this in mind, we know that the absence of any publicly available and detailed methodologies will further exacerbate the lack of transparency for investors and thereby create another playing field for greenwashing. And the regulation that we currently see, namely the CSRD, namely the EU taxonomy, they are supposed to contribute to more consistency, to clearer definitions and standards, but then they would also require those rating methodologies to change and to better respond and adopt some of the regulatory elements. Finally, I would like to go and talk a little bit about the ratings perspective. So what are rating agencies currently facing in terms of challenges from the regulation, but also how do they respond to it? Now, first of all, let me give you 2 quotes that I consider extremely important in this context. One is from Merritt McGuinness, EU Commissioner for Financial Services, and this quote is from November 2020. She said, we need a complete rethink. Sustainable finance needs to become mainstream to have a transformative impact on society and on the planet, while also generating strong returns. So the transformative impact is the most important element of this quote, and it shows that those ratings and assessments that we will see in the future will have to focus on forward-looking components. So it's much more important to look at how does a company try and seek to contribute to the transformation than to look at what they are currently doing. In other words, if you're a cement company, then the focus will be on your investment strategy. So what is the share of your sustainable investment, rather than looking at your current energy mix in production? And the second important point came from the former chair of the European Securities and Markets Authority, January 2021. We raised specific points in relation to ESG ratings, such as the lack of a legally binding definition and comparability among providers of ESG ratings, or legal requirements to ensure transparency of underlying methodologies of such ratings. And this is exactly the area I pointed to before. We see that the current ESG ratings do not show any comparability. We have a lack of transparency, and that will change with the regulation of ESG ratings if it comes from the European Union. Transformative impact and regulation will be the most important topics for ESG ratings. An area that we have not yet spoken about is then the consequence this has for credit ratings and for ESG ratings. So will there be an integration of ESG into credit ratings only, or will there be two different ratings in the future? One a credit rating and one being an ESG rating. I think there's no conclusion of that discussion yet, but what we observe in the market today is, of course, that we have both. We have credit risk and we have some ESG risk elements included in credit risk. And then we have credit ratings and we have ESG impact ratings or ESG ratings on the side. So if we look at the left table first, so the integration of ESG and credit risk, here we see that there's, of course, a strong correlation between financial materiality and the risk horizon, which is key for inclusion of ESG risks. So every rating agency, every credit rating agency, and the analysts there will only look at those ESG risks which are supposedly materializing over the next few years, such as an increase, a step up in the carbon price or in the carbon tax by a jurisdiction is certainly going to affect a credit rating because it's financially material. However, if a company is subject to some carbon risk back in its supply chain, that's probably of less relevance for a credit rating today. So the investor relevance of a credit rating is rather short term. And the market environment is also clear. We have a high market saturation of established credit ratings with short-term risk horizon. So what is missing is kind of a long-term element to that credit rating. And this could potentially be satisfied by an additional assessment, which is then not an integral part of the credit risk analysis, with some correlation if we think about near-term risks that materialize and that are clearly also impacting wider society. But we do not see a direct quantifiable link to financial materiality because ESG impact rather looks at the footprint of a corporate to wider society instead of looking directly at the short-term impact. So in a sense, an ESG impact rating would clarify for investors whether a company's business models is sustainable in the long term in the sense of either providing a positive impact on wider society or at least by not imposing a negative impact. For now, in the market environment, we have a very limited market penetration of such ratings with long-term risk horizons, or let's say of impact ratings. And this is supposedly going to change with the uptake of investor interest and with the emerging regulation that takes a lot more into account this impact on society definition, rather than looking only at reputational or some environmental regulation risks that come towards the corporates. So in a sense, what I would like to stress here and emphasize again is the fact that for now, we see that corporates are mostly dealing with ESG-related risks that are important for financial materiality. In the future, with the CSRD regulation, also with the EU taxonomy, we will definitely have to shift the focus, and it's going to be about impact. It's going to be about assessing the company's willingness and ability to change, to transform their business models if they need to transform in the direction of more sustainability and lower footprints. And this kind of double materiality, to look at the one hand side on financial materiality and on the other hand side on the impact to society. That's exactly the approach that the Scope Group is also following, and where we see that with fund analysis, one part of Scope, and with credit ratings, the other side of Scope, we have two important institutional capacities that will gradually include and integrate this value to society approach exactly in line with the regulatory development. And that is something where we find that investors are increasingly interested in that type of dimension, and also corporates are very much interested in trying to better understand what is a credit rating, what is an ESG rating, where are the differences, and how do they emerge over time. Thank you very much for your attention.
Thanks a lot, Bernard, for this insightful presentation. We all want to avoid greenwashing and better select our ESG compliant investments. Now let's move to the next presentation by Kiriba. As said, it came out of the last surveys that many treasurers are contemplating a change and upgrade of their TMSs, and the implementation effort are always feared. It needs to be demystified. This presentation will be an interview between Guillaume Rocher, VP Sales Strategic South Europe at Kiriba, and one of their customers based in Luxembourg, Majorel. Odile Brandstatter, Vice President Treasury, Majorel, and Sanae Manouri, a Corporate Treasury Manager. They will talk about the best way to roll out a TMS project with an integrated cloud platform and give us tips for a successful project. Dear all, the floor is yours.
Good evening, everyone. Welcome to Sana and Odile for this event today that will allow us to know more about your transformation journey. So again, it would have been a pleasure to meet you physically, but unfortunately, there's some operational requests which force us to remotely do it and to have it not live. But we are really pleased again to welcome Odile and Sana. So maybe a quick introduction for both of you, and then it will be very helpful, I would say, to better understand who is Majorel.
Thanks, Guillaume. So hello, everyone. Very happy to be with you, even remotely, and to speak about our TMS project with Kiriba. So I'm Odile Brandstatter. I'm head of Treasury at Majorel. I was hired in July 2019. I'm originally French. I have two sons, and I'm here today with Sana, who is almost live from Casablanca.
Hello, thank you, Odile. Thank you, Guillaume, for inviting us even remotely. So I am happy to share with you our experience with Kiriba. I started with first, I introduced myself. I started with Majorel in January 2021 as Corporate Treasury Manager. And I'm working on cash management topic for the group as a support to our region, and mainly this project of transformation of the implementation of the treasury management system.
So let's talk a little bit about who is Majorel, and where are you in this transformation journey? I think there's a lot of things that happened recently that explain also why you are where you are.
So Majorel is a joint venture created at the beginning of 2019 by two family-owned companies, the Bertelsmann Group, the German media group, and the Saham Group, so a family-owned business in Morocco. Our activity is outsourcing of customer experience. So we work for all the global internet industry and all the sectors that need to manage their customer relationship. We are present all over the world, on all continents, in currently 36 countries, if I'm not wrong, because we open new countries very often, and we grow both organically and externally. And one of our last big milestone was the IPO. We got listed in September 2021 at Euronext Amsterdam.
Good. So that means that you may have a lot of challenge to face, I guess, with all that what you share. So tell us a little bit more about what were your challenges that you are facing, and from an operational standpoint, from a control standpoint, as head of Treasury.
So indeed, because the venture was created in 2019, it all started with a service agreement with the Bertelsmann Group. So it's actually Bertelsmann Treasury who was managing our cash at the very beginning. And then since I joined the company, I've been working on creating our own processes, which were more tailor-made to Majorel. I initiated with the colleagues who were there at that time the very first cash flow forecasts. This was also then the opportunity to build a treasury community and a treasury team. So there were also obviously several recruitments and hiring. And this is how it all started. And we were, from day one, my main mission was that we would become autonomous from a process perspective. So meaning we had to cut this service agreement we had with Bertelsmann, and we had to cut it so step by step with a timeline that was, by the way, not known at that time, and which definitely accelerated last year when we were announced that we would go for this IPO. And so in the meantime, yes, many people have joined the Treasury team. We are now 16 people all around the world. And we indeed have launched this also this journey with the system transformation and the TMS.
Okay, so that means that obviously it's a lot of transformation to be done or implementation to be done. So I guess it's not only Treasury that you are mentioning, because you have to do more or less everything.
The Majorel Group is indeed very much focused into the future, the growth and digitization. So there is actually, besides the Treasury Department, we actually have a finance transformation department. So they do all the journey about ERP migration, standardization, reporting factory, and we work hand in hand with them so that we can indeed benefit from the tools that they are implementing, and that we can interface all of these systems.
Okay, and in the project itself, could we say that it's Treasury that include also the payment part, the part of risk and potential fraud, or so the extensive, I would say, perimeter of the classic TMS?
So maybe Sana can explain how, when she started in the company, what that meant in terms of managing the bank accounts in your scope.
When I started with the Majorel in January 2021, the main mission, as Odile mentioned, was the internalization of our treasury processes to be autonomous from the shareholder, Bertelsmann. So 2021 was mainly a year of internalization, of transformation. This internalization implied that we inherited a package of several systems of treasury with different functionalities. So for inside of the treasury itself, we had many accesses to several tools. Therefore, internally, our big question was whether we should keep all these systems or whether we need a new tool that encloses all the functionalities and that accompany us in our vision of the future of the treasury. So this was the starting point.
And actually, really the main and very first topic was about getting visibility on our bank accounts. That was, I think, almost my very first question when I joined the company. Is actually how much cash do we have? And so, when we were thinking about this TMS project, that was also one of the key elements. It was to have this visibility on all our bank accounts, and then indeed. The next topics were, so how do we go about standardizing our payment processes? Because as we said, we are in 36 countries, so that means that we don't really have 36 different payment solutions, but we have a lot, and they are very decentralized. So the idea was also, do we standardize this? Is this now a good opportunity to do it? And so that's how we approached the beginning of the project.
So there was this visibility, clear vision and needs. There was also this standardization. Is there any other topics that were essential during the selection process that you have done?
Yes, so having this control over our operations and obviously keeping always in mind the risk part. Whether it's fraud risk, which is obviously a very present topic in our industry, whether it's the FX risk or all that relates to macroeconomics, and obviously the liquidity risk. So we were really aiming to have an instrument which enabled us to be, let's say, fit for IPO, actually fit for playing, in a bigger league, and to have the appropriate processes, both in terms of internal operations and using some very high-level instruments in order to help us to manage our operations.
Okay, so then. It seems that you have selected Kiriba, so maybe, and thank you for that, and we are honored, obviously, to serve you. What are the key elements that, from your perspective, has make you taking that choice?
Sana, would you like to describe the RFP timeline? And
we first launched an RFP where we listed the main functionalities and expectation about the TMS, to which a number of editors responded, including Kiriba. In the RFP, we were very clear about our expectation and the features to be implemented. During the first selection, number of editors replied, and we organized demo sessions for each editor, and we were mainly focused about the technology, the number of features that are covered by the solution, and the ease of the accessibility for the users. So after this first selection, 3 only editors were selected. Were
in the shortlist.
In the shortlist, exactly. So we're reduced to 3. So the list was reduced to 3 editors. Then our next challenge was to share with them a concrete case study that reflects our environment. As you know, Majorel is in current and continuous expansion. So we shared with them a study case that reflects that. And we were challenging them about the adaptability to our environment and how they will find the solution to, and how they will be able to respond to this case study. Then the answer was simply Kiriba, because they in terms of challenges, they were the one that made us feel comfortable with how they resolved the problematic.
Yes, and indeed, if I remember correctly, the several case studies we had, we were very much focused on emerging countries because that's how the Majorel's business model operates. So we do have a lot of exotic currencies, a lot of countries where there are many restrictions in terms of circulation of cash. So indeed, the case study was about creating a payment factory in one of our emerging country, being managed from another emerging country, with all the FX risk and the intercompany funding. And so, yes, we were then convinced by the solution we had in front of us.
So, and that's something that is really helpful again to understand what are the key drivers. I was thinking about being a SaaS solution, meaning a real SaaS solution, having a unique solution for every and all customer. So obviously leveraging all the innovation coming from one customer to the whole ecosystem. Obviously leveraging also as well all the format for the bank that we are using for many years and share it with all our customer. Was it a key element also of adopting Kyriba solution?
Yes, indeed. It's first of all, it's Majorel strategy to go for SaaS solution for an obvious perspective of agility. We have considered several perspectives. And indeed, for a question of being, able to benefit from the various updates and having a flexible solution which could also be onboarded by colleagues all over the world, SaaS, yes, was the obvious choice.
And as well, it was about the agility, the security, the ease of access to our users, and the simplicity as well. It's like we did put a whole list of criteria that make the SaaS the most suitable for us and for our strategy.
Okay, so let's talk a little bit about the project now into more details. So tell us more about the project organization, involvement of your team, maybe of yourself. What are the main timeline? And I guess you also have a partner, an integrator as part of it, which is part of the picture. So yeah, can you give us some insight on this?
So we made our decision at the end of the summer of 2021. Sana, who had led the RFP, was then very naturally appointed project manager for the implementation and started to work, I would say, immediately with the integrator. So can you tell us how this has started then?
From the signature of the contract, a kick-off call was organized with our group CFSO and our CFOs, the goal being to launch the project and to federate all the regions around the tool. Then we organized with our integrator, AirPage, the sessions and workshop to design the tool. In these sessions, we went deeply about each function and how we intend to optimize it, to ameliorate it. After these sessions, we started the configuration phase. And for information, always in the first step in the design phase, the company needs to launch in the same time a parallel session with the banks to sign the contracts. And this is needed before the configuration, because once you start the configuration, you need all parties to be already in the project and know what we are expecting from them. So the sessions with the banks started in parallel with the design phase, and in the same time, the sessions with IT department, HR department, and other and payments department. These sessions as well, they are important before the setup, for the interfacing with other systems, for making sure that all parties are ready to the setup phase. Today, we finalized successfully the setup, and we are in testing mode. And we can say that the implementation is going so far as expected, and all parties, they were really engaged and motivated as us, as the Treasury department, to have this new tool, new technology inside the group.
We actually had several targets that we wanted to realize at the same time. So sort of a matrix project. We first wanted to have a first geographical scope that would go live on Kiriba rapidly. And so we chose actually the headquarters. So the bank accounts we have in the various currencies for the headquarters. And then we wanted to, for the second wave, to have both an expansion of the geography and further modules that would come on top. So, but our very first target, which Sana just described and which is about to go live in just a couple of weeks, was that we connect and have the first payments on the headquarters bank accounts.
Okay, good. So that seems on track, which is a good news. It's always, I think, interesting to look at what are maybe the lesson learned or some challenge and even problems you faced and you did not anticipate, or you maybe under anticipate some of them. What are maybe the lesson learned that we can share with the ATEL community on this, so they can leverage that in the future similar project, if any, of course?
My lesson learning and my advice is to anticipate. As I said, the project, it doesn't involve only the Treasury department. It involves as well other departments. And if they are not ready as you are, the project risk to be delayed by. It depends by weeks, by months. So the anticipation is very important. And in this first phase, we learned what is needed, what are the prerequisites. So we did a sort of chart that we will use for our next implementation in our regions. And this will help us to have a smooth implementation and to respect our deadlines.
So internal marketing is really key. Getting everybody on board, because it does require a lot of resources internally and way outside of Treasury. So yes, obviously it was much easier to get the support of the treasurers than all of the other departments. So this question of internal communication and internal marketing takes a lot of time. We were probably quite privileged to have the support by our CFO and by our CEO, who from day one were convinced about the necessity of having this treasury transformation, as well as they are convinced about the finance transformation of the company. And what was also very helpful for us, and who probably allowed us to have maybe one challenge less, is that also already during the RFP and very soon when we started to work with Kiriba and with the integrator, we had very good resources in terms of planning the calendar, planning the resources. We had a very clear view on how many workshops would be necessary, on how many hours of training, how many people would be needing to work week by week on the project. And I think this was very helpful for us in order to organize ourselves and to communicate with the relevant colleagues.
I think it's a key point, by the way, that you re-insist on the fact that the C-level must be part of that journey and must be sponsor of this initiative. And I can tell you that it's the case within Majorel. I met your CFO, which is highly interesting in the details of what you are doing here. So I think it's good to remind to everyone that it's also another, I would say, key success criteria to make it happen.
And just to add on that, the fact is digitization and creativity are actually part of the Majorel DNA. So that's also a bit easier for us then. Even more easy.
So maybe let's take some kind of helicopter view. Or where do you plan to be in? So you have short term, I would say, short term things that are coming, and with go live and with deployment. What do you see then as the next step, as the leader of that department, Odile? How do you see the future?
So regarding the TMS, we are accelerating now the implementation, or we start the acceleration in a few weeks and in a few months, and we will now start onboarding the bank accounts in all of our regions between next year, the year after, and probably the year after. And I'm also quite sure that by then we will have many more new countries to onboard. So that's for sure something that we will not be bored about in the next month. And then once this implementation is more concrete, and once we can really benefit from the use of this new TMS, I really hope that, I expect actually that that Treasury will be less and less about data crunching and collecting data, and more about analyzing them, adding value to them, providing recommendations for the company, for the other departments, and actually being a really even better business partner inside the group. And that we can also focus on all the other stakes, and that Treasury is actually an instrument and not something that we need to struggle with and with Excel tables. So I really look forward to this next step of being even more performing.
Yeah, and I would say that it could be on top a way to leverage also the platform you put in place to launch initiative regarding working capital or regarding forecasting and planning. So I guess there's still many options and potential improvement to be made, and that's why it is exciting, I guess, to have this kind of transformation journey again. So I think that we have covered, I would say, roughly the entire perimeter that we want to share today. I don't know if you want to add anything, Sana or Odile, to what we said.
What I can add, so as a conclusion maybe, is that I'm very satisfied with the way this project is currently developing. I'm very satisfied about the project management and about the partners that we have chosen. I again really look forward that now the whole group will soon onboard on this journey with us. I look forward to these next steps when we will be able to concentrate so more on these value-added tasks of Treasury. You also need to imagine that we have initiated this project during the COVID pandemic, so with everybody working remotely. In this context of we were about to being listed, so I'm especially proud that the team has managed to do this in this challenging context, I must say, and that we are still very much on track with the initial calendar. And so the fact that we are about to migrate really in a couple of weeks to this world-class TMS makes me personally very proud, and is something that I consider as a real outstanding achievement.
I think it was indeed a great achievement. So even if you have some milestone to achieve before getting fully live, that's great news to hear where you are at the moment. So again, thank you very much for this testimony. It was great to have this lesson learned and return on this project. Thank you for your trust again, and happy to answer to all questions that will come in the Q&A in the live session at the moment, and see you soon, very, very fast.
Thank you. See you soon.
Thanks Odile, Sanae and Guillaume for this inspiring presentation. Now let's come to our last presentation for today's conference. I will invite Datalog, TMS and bank single gateway provider, to make a presentation on in-house banks. It also appeared in last survey that organization of Treasury is under review together with the ad hoc tool to succeed in implementing a full operational platform and to be ready to face the next crisis and challenges. Let me introduce Arnaud Getzinger, Product Manager. Arnaud, welcome.
So good morning, everybody. Today, I'm happy to be with you for the ATEL conference, and we will talk about the in-house bank, what it is, what are the benefits, and how we implement it in a treasury management system. So I'm Arnaud Getzinger. I'm the VP Product Management for Datalog Finance. I joined 8 months ago. Before that, I worked in several corporate treasury, Valeo, ATEL, and Eurofins, and various positions of back office, front office, cash management, and system implementation. So first of all, what is an in-house bank? An in-house bank, in a way, is the fact that you internalize some banking services that traditional banks, external banks, can do for you. For instance, they process payments, they manage or they deal with you some FX transaction or interest rate transactions, and so on. So basically, you will internalize those services within your organization, and it has several benefits. So first of all, it allows you to streamline the account management across the group. Why? Because you can do, for instance, a payment on behalf of, and in this case, you will have a limited number of accounts from which you will pay everything you need on behalf of your subsidiaries. It will allow you also to centralize the cash management operation. So we talked about the payment, but we will talk about also about the cash centralization. So you can implement cash pools and so on to make sure that your cash is centralized within your group at the top level. It will help you to improve your internal processes and to increase your security. So improve your internal processes, because as you will be the banker of the group, you will be able to tell your subs which type of SLAs, which type of processes they can expect from you. While with a bank, there are always discussions, there are always a lot of contracts to sign. You can't be sure about your deadlines and so on. And in terms of security, as you internalize many transactions, it's you don't have banking flows with external partners. It stays within the group, so you have less risk of paying to an erroneous counterparty. If you do an in-house bank, you need to have real-time data, real-time visibility, and you are able to better control your risk because you have a unique database where you can fetch the data and make sure that you hedge properly your risk. Then, with all the regulation about transfer price policy and so on, you can also better adjust your interest rate to the risk profile of each subsidiary. So instead of giving the same rate, FX rate, interest rate, and so on, to everyone in your group, you can say, this is a big sub, very profitable, and so on. So I give a better rate than a startup sub, for instance, or a loss-making sub. And this is very important for tax purposes. And at the end, you also better structure your banking relationship because you internalize what you want, what you think you can bring value with. And on the other side, you give to the bankers that what you consider is more complex or that you will deal in a less efficient way. So you can really choose what brings value to your external banks and internalize what you think is deemed to be done by yourself. So now we need to think strategically before implementing. You need to, let's say, to conceptualize how you will create your in-house bank. So basically, first of all, you need to define your organization hierarchy, meaning that you have one head entity, but then will you have some intermediary levels at country level, at regional level, by business line? So you need to define all that. For instance, you can have a management of the in-house bank in Asia and in the US because of time lag. This is a first step. This will allow you to define which type of relationship you will create with your subsidiaries. So which type of current accounts, how they will be linked with ultimately the in-house bank, the ultimate in-house bank. And will there be any intermediary steps? Then you need to define also some limits or not, depending on how you want to manage your risk. But for instance, if you implement a cash pool, you may consider that a sub cannot get unlimited financing through a cash pool. So maybe you will need to define limits based on the size, the profitability, and so on of the subsidiary. Once you have all that, you will know in which country, which type of services, you have signed your contracts or you are preparing your contracts. Now you need to define which type of market risk you will be exposed to and how you will hedge it. So if we talk about cash pooling or financing in general, you will have risk in terms of interest rate in different currencies, Euribor, LIBOR dollar, LIBOR GPY, and so on. So you need to define all your interest rates that you will be exposed to, and you will need to know which type of interest, because Euribor, LIBOR are expiring now, so you need to go on other rates like Esther and so on. And you need also to define the spread that you will apply to each sub or group of subsidiaries. Finally, when you have all that, you need to define how you will work with it. So you need to define your workflows and the life cycle of the transactions. If it's a cash pool, it's quite easy. You open a current account and then the flows goes regularly on this account. If you have more complex transactions, like loans and so on that are more long-term, you will need to know what you do with the transaction. You extend, you repay by anticipation, and so on. We say that an in-house bank is the fact of internalizing the traditional activity of external banks. So it brings benefits in terms of cost and so on, but there are also some constraints. So you need to also strategically think about your processes. Basically, you need to automate, to standardize, and to simplify. Why? Because you will have a limited number of resources internally. And before, it was a business that was done by external banks, which means that you will have more workload on your colleagues. So automating, standardizing, and simplifying will be a key factor of success to make sure your internal bank can work properly. Then you need to have a comprehensive approach. When you do those kind of activities in terms of in-house bank, you need to define your processes. So a front to back, potentially to middle for control, but also to reporting and to payment. This is very important to know what is the output of what you will do in terms of reporting and make sure you can do your payments as they fall due. Then a clear benefit that we will have, which is more qualitative, let's say, but very important, is to have a unified and centralized data management. So you will have a unique system with a unique database, which means that you will have all the data to take your decision real time or close to real time. And you will not have to request your subsidiaries to report to you with a time lag and so on. So it will really increase the quality and the timing of data that you have within your group. And last but not least, we know that regulation is increasing drastically in the world. So with this kind of system and with this kind of activity, you need to make sure you comply with the rules in terms of withholding tax, in terms of transfer pricing policy. You need to make sure you report correctly to your auditors. So having a system will be a key factor to make sure that you don't make mistakes, because we know that using Excel and so on is prone to errors. And you will have auditability through an audit trail. And you will be sure that you respect, or if you can conceptualize correctly, you will be able to provide the right rates and so on to your subs. So now let's go to a real use case and what we can do in a TMS. So we will talk today about the financing activity of your subs. So two ways to finance your subs, either by cash pooling, which is the easiest case. You ask your banks to do this work on your behalf, and you just see on the bank statements that some transactions appear and it's a zero balance account, a target balance account, and so on. Or you allow your sub to do manual funding request of cash pooling. They request the funds and you send it with not much process than this. The other way of doing it is to use more complex transactions, meaning intercolon or injecting equity if their equity position is too low. This is more complex because those are more structured transactions with a maturity date, with the option to send the fund progressively, to extend, or to repay by anticipation, and so on. So this is the case that we will deal with today. So in a TMS, basically, you, in order to comply also with the tax regulation and so on, we, for a customer, we implemented one solution, which was to use revolving credit facility. So basically, the subs could request their fund progressively. We just implemented a credit line, which was an envelope pre-validated of funding, for instance, 1 million euro. And then the sub could request progressively by tranches of 50k euro or 100k euro. And in this situation, the idea was to, as we said before, to streamline and to standardize as much as possible to make sure that it was not too much resource consuming. So basically, we prepared all the setups in terms of interest rate, in terms of withholding tax, and the users needed only to input in the system a few, let's say, necessary data to make sure that the system could find the correct interest conditions. So basically, with the lender, with the borrower, what type of loan. So in this corporate, we had at least 10 different generic financial conditions: senior loan, junior loan, deeply subordinating loan, bridge senior, bridge junior, bridge DS, and so on, plus some specific rate for real estate, for instance, and so on. And this was defined also by currency. So in total, this made roughly 400 standard conditions. So of course, if you have 400 different type of conditions, you make mistakes. That's why we prepared all the setup in advance, and the user had to just to select the type of loan. And then based on this type of loan, the system was able to find the right condition in terms of interest and withholding tax. So as you can see on the screen, if we take the screen in the middle, this was the interest rate setup. So basically, it's a matter of defining the right criteria. In our case, it was on a tranche, a senior loan in GPY, and so on. So you define your conditions, and then there was a 3 months period with a changing rate. So each quarter, the customer was uploading the updated condition. On the right screen, you have the withholding tax that applied to the interest. So it's just one standard setup saying, okay, on the interest that was defined previously for Japan, in our case, the withholding tax is, for instance, 10%. And you see on the screen on the right, on the left, sorry, the schedule of interest. So on the top of the schedule, you have the interest. At the bottom, you have the withholding tax. And the system computes regularly, every day, actually, the right position of interest rate and withholding tax based on the drawings and reimbursement. So at the end, of course, you need to monitor your activity. So you can execute some reporting. So on the left bottom, you see, for instance, a statement of interest that you will send to your subs that you can automate through schedulers in order to tell them what they need to pay. On the left top, you have, for instance, a benchmark of your portfolio versus a market rate, and so on. So many reporting that you need to produce, either for regulatory reasons, for your management, and so on. And of course, you will also generate automatically the accounting. So if we talk very quickly about Datalog, so we are a provider of integrated TMS. So basically, we manage the payment and the payment factory, the in-house bank, cash management, and risk activities. And we have some add-ons in terms of Swift GPI, in terms of BAM, and so on. We are adaptable and scalable. So we have a modular system. You can take one module and not the other. And we also are able to implement the system on-premise or on cloud. We are international experts, so we have many projects across the world, thanks to our customers. And we are located in 3 locations, so Paris, Montreal, and in Asia, in Singapore and Malaysia. So as I said, we are also a SaaS provider. So we provide a multi-tenant SaaS, but with one database by client for security purposes. But if you want, we can do on-premise solution. Very important, we have a scheduler integrated and embedded in our solution, so you can really automate very easily your activity and make all the low-value tasks, let's say, automated. And we are secured and efficient, so in terms of security control, we are Swift audited, we have compliance with ISAE 3402, and we have implemented state-of-the-art security functionalities. So thank you very much for our discussion today, and don't hesitate to follow us on LinkedIn.
Thanks, Arnaud, for this interesting presentation on in-house banks and how to become more performing. I wanted, before closing this virtual spring conference, thank all the three sponsors, Kyriba, Scope, and Datalog. Thanks for your support. I hope you have enjoyed our conference as we did. Have a nice day and see you soon to one of our next ATEL in-person or virtual events. You are more than welcome.